Today, in this video, we will talk about how smart money really moved gold and why you keep losing trades. You open your chart. Gold looks clean. The resistance is obvious. The trend seems clear. Everything lines up the way it's supposed to. You take the trade with confidence. And then, price moves against you. Not slowly, not randomly. It spikes directly into your stop loss, takes you out of the trade, and then, almost immediately, it goes exactly where you originally expected. At first, it feels like bad luck. Then it happens again, and again, and again. Eventually, you start asking questions most traders ask at some point. Is the market manipulated? Why does it always seem like it's moving against me? Who is actually on the other side of my trades? Here's the truth that most people never fully understand. You're not just trading the market. You're trading against players who move the market. And those players are not guessing. They are not reacting emotionally. They are operating with intention. They are what we call smart money. Smart money isn't one person or one entity. It's banks, hedge funds, institutions, liquidity providers, and even central banks. These are the participants who have the capital to actually move price. And because they operate with massive size, they cannot enter or exit trades the way you do. You can open a trade instantly with one click. They can't. If they want to buy or sell large positions, they need liquidity. They need orders on the other side. And that's where you come in. Because every time you place a trade, every time you set a stop loss, every time you place a breakout order, you are creating liquidity. And price is constantly moving toward that liquidity. This is the part most traders miss. They focus on patterns, indicators, and strategies, trying to predict where price will go. But price isn't moving because of patterns. It's moving because of orders, because of liquidity. Think about how most traders operate. They see a resistance level, and they decide to sell. They place their stop loss just above that resistance. That means above that level, there are buy orders sitting in the market, a pool of liquidity. Now imagine you're a large institution and you want to sell a massive position. You need buyers. Where are the buyers? Right above that resistance. So what do? You push price above that level. You trigger all those buy orders. You trigger the stop losses of sellers. Liquidity floods into the market. And then, once you have enough liquidity, you execute your sell orders. Price reverses. What looked like a breakout was actually a trap. This is why fake breakouts happen so often. This is why you feel like the market is targeting your stop loss. It's not personal. It's structural. Price is engineered to move from one pool of liquidity to another. If you step back and observe the market without emotion, you'll start to see a repeating cycle. First, price consolidates. It moves in a range. Nothing exciting happens. Most traders lose interest here. But this is where smart money is active. This is where positions are being built quietly, without drawing attention. Then, price moves outside of that range. It breaks a high or a low. Retail traders react instantly. Breakout traders enter. Stop losses get triggered. Liquidity is created. That's when the real move begins. Price moves aggressively in the opposite direction. Strong momentum, large candles, clear intent. This is what we call displacement. But by the time most traders recognize the move, it's already too late. They either get trapped in the wrong direction, or they chase the move after it's already started. Then comes the pullback. Price retraces. This is where many traders get confused. They think the move is over. They think the market is reversing again. But in reality, this is where institutions are refining their positions. They're entering again. They're managing risk. They're preparing for continuation. And then price continues in the original direction. The cycle repeats over and over again. When you understand this cycle, the market starts to make sense. Not as something random, but as something structured. And when it comes to gold, this structure becomes even more visible. Gold is one of the most reactive and institutionally driven markets in the world. It responds to macroeconomic factors like inflation, interest rates, currency strength, and global uncertainty. This means large players are constantly involved. And because of that, gold tends to move aggressively. It spikes, it sweeps levels, it reverses sharply. It creates the perfect environment for liquidity-based movements. You'll often see gold take out equal highs or equal lows with precision. You'll see it break key levels just to reverse immediately. You'll see strong moves that leave imbalances in the market, only for price to return later and continue. To an untrained eye, this looks chaotic. But once you understand liquidity, it becomes clear. It's efficient. It goes exactly where it needs to go to access orders. Now think about your own trading experience. How many times have you entered a breakout, only to get stopped out? How many times has price barely touched your stop loss before reversing? How many times have you hesitated, missed a move, then entered late and lost? These are not isolated events. They are patterns, and they all come back to the same issue, thinking like the majority. Most traders are trained to look for entries, but the real edge comes from understanding where others are entering and where they are wrong. Instead of asking where you should buy or sell, start asking where traders are trapped. Where are the stop losses? Where is the liquidity? Where would a large institution need price to go in order to execute their positions? When you start asking those questions, your perspective shifts. You stop chasing breakouts. You start waiting for them to fail. You stop entering at obvious levels. You start waiting for price to move beyond them. You stop reacting. You start anticipating. And that's where everything changes. Because now, instead of being the liquidity, you are aligning with the forces that seek it. This doesn't mean you will win every trade, but it means you will understand why you win and why you lose. And that understanding is what separates consistency from randomness. Timing also plays a huge role, especially in gold. Not all hours in the market are equal. The most significant moves tend to happen during the London and New York sessions. This is when institutional activity is highest. This is when liquidity is taken and real moves are made. If you're trading outside of these sessions, you're often operating in lower volume conditions, where price can behave differently. Understanding when smart money is active is just as important as understanding how it moves. At the end of the day, the market is not designed to make things easy. It's designed in a way that rewards understanding and punishes predictability. Most traders lose because they follow the same logic. They see the same patterns, they place their trades in the same areas, and that makes them easy targets. But once you shift your perspective, once you start thinking in terms of liquidity instead of patterns, everything begins to align. You start seeing the traps before they happen. You start recognizing the intent behind price movements. You stop feeling like the market is against you, and start realizing you were just looking at it the wrong way. So the next time you open your chart, don't just look at where price is. Look at where it's going. Not based on indicators, not based on predictions, but based on liquidity, because price will always move toward it. And once you truly understand that, you'll never see the market the same way again. If you want more trading content like this, subscribe to the channel.